Gold up over 50%, stocks up over 40%. Yield curve steepened, consumer spending strong. 4 signals, 4 different directions. Gold says crisis, stocks say confidence. Yield curve says recession, consumer spending says everything's fine. And here's what almost nobody sees. These 4 indicators don't typically align. When gold surges, stocks don't rally. When yield curves steepen, spending collapses. They can't all be right. Something has to break. And institutions already know which one breaks first. Let's start with what each signal traditionally means. Because understanding the contradiction requires seeing why these 4 should never point different directions simultaneously. Gold surging over 50% over 2 years. Historically, that's a crisis signal. In 1973, gold jumped 50% right before a brutal recession. In 1980, same pattern. In 2008, gold climbed 50% in 6 months before the financial system nearly collapsed. When gold explodes like this, investors are fleeing to safety. They're abandoning risk assets and piling into the one thing governments can't print away. Gold screaming this loud should mean stocks are crashing. But here's where it gets interesting. Stocks are up over 40% in the same period. The S&P just hit record highs. That's not supposed to happen when gold is flashing red. Stocks rally when confidence is high, when risk feels rewarded, not avoided. Gold and stocks both surging? That contradiction alone is extremely rare. But here's what most people miss. The yield curve steepened over 12 months ago. And if you followed markets, you know what that signals. The yield curve has warned of every recession since 1969. But the inversion itself isn't the signal. The steepening back above zero is what marks the beginning. It happened in 2019. Recession followed. 2007, financial crisis. 2000, dot-com crash. 1989, recession. Even 1929 followed the same pattern. When the yield curve steepens, consumer spending should decline. Unemployment should spike. The economy should break, or at least correct. Except, here's the kicker. Consumer spending has been surprisingly resilient. And we know consumer spending represents around 70% of GDP. And it's been solid, people still buying, credit cards still flowing, retail holding up despite everything else flashing warnings. So you've got gold screaming crisis while stocks celebrate confidence. A yield curve saying recession while consumers keep spending like nothing's wrong. This is the setup almost nobody understands. These 4 signals aren't just contradicting each other. They're all measuring the same underlying reality from different angles. And when you see what's really happening beneath the surface, you'll understand exactly which one breaks first. These 4 signals are connected by 3 forces temporarily holding this contradiction together. But when you understand how the forces work, you'll see why this alignment can't last. Force number 1, dollar devaluation disguised as growth. Start with why both gold and stocks can rally simultaneously. This shouldn't be possible. But here's the part hiding in plain sight. The dollar. It's down more than 9% over the last year. Inflation has cooled but remains stubbornly elevated. Gold is a hard asset. Central banks have been buying gold in record amounts, in part to reduce their reliance on a weakening dollar as a reserve currency. Also, as real interest rates decline, gold becomes more attractive. Higher prices lead to higher nominal earnings. Much of the recent earnings growth isn't coming from higher productivity, it's coming from higher prices as the dollar buys less. Wall Street calls it record earnings. In reality, much of it is inflation disguised as growth. Corporate profit margins over 13% of GDP, the highest in history. Not because businesses became more efficient, because pricing power allowed them to raise prices faster than costs. Those inflated profits flow back into stock buybacks and reinvestment that pushes equity prices higher. And here's where it all starts to click. That's why stocks keep climbing even though the economy feels broken. Earnings look strong on paper, but strip out inflation and the growth is not as real as it seems. Meanwhile, gold is doing what it always does when the dollar weakens. It rises. The world's largest financial institutions are stockpiling gold at unprecedented rates. When trust in the dollar erodes, gold becomes the lifeboat. They're preparing for something most people haven't even considered. So both signals are correct. Stocks rising because nominal earnings inflate, gold rising because the dollar weakens. same force, two different reactions. But here's the real magic. Force number 2, the hiring freeze illusion. Now let's look at why the yield curve steepened over a year ago, but a recession hasn't landed yet. The yield curve steepening should trigger an economic slowdown. Layoffs, a spike in unemployment, consumer spending deteriorating. That's what happened in every previous cycle. But this time, something's different. Companies aren't laying people off, but they're not hiring anyone either. Existing workers keep their jobs. Profit margins stay high because payroll isn't growing. Wall Street loves it. No layoff headlines, stock prices climb. But anyone entering the workforce, switching careers, or re-entering after time off, they can't find anything. Unemployment rises without a single layoff hitting the news. And here's the part no one talks about. This only works until it doesn't. When you freeze hiring for 18 months, your workforce stretches too thin. Projects slow. Revenue growth stalls. Eventually, the hiring freeze transitions to layoffs. And it's already starting. By late last year, US employers announced 1.2 million job cuts, highest since 2020 and a 54% increase from the prior year. Unemployment just hit a 4-year high. The yield curve wasn't wrong, it was just early, and the delayed reaction is what makes this dangerous, which brings us to the third force, and this is the one that breaks everything. Force number 3. Consumer spending on borrowed time. Consumer spending makes up 70% of the economy. Everything depends on it. Corporate earnings, GDP growth, market valuations, all of it rests on consumers continuing to spend. And spending has been holding up. But here's what you'll never hear on the financial news. Consumers have been spending money they don't have. Household debt just exceeded $18.5 trillion, all-time high. Savings depleted. Over 60% of Americans living paycheck to paycheck. They're not spending because they feel confident. They're spending because they have no choice. Rent still due, groceries still needed, and prices are 20% higher than 3 years ago. But 3 pressures are converging that will break consumer spending all at once. First, the hiring freeze is transitioning to actual layoffs. Employers announced over 1 million layoffs late last year. When people lose jobs, spending stops immediately. Second, inflation has been squeezing purchasing power for years. Even people who kept jobs can't afford what they could 18 months ago. Third, high household debt with elevated rates means debt service costs keep climbing. Every dollar servicing debt is a dollar not going to consumption. Deloitte forecasts real consumer spending growth slowing to 1.6% this year, down from 2.6% last year due to tariffs and a weakening job market. When consumer spending collapses, corporate earnings collapse, GDP falls, stock valuations get repriced violently downward. That's the force that breaks first. And once it breaks, all 4 signals resolve instantly. Let me show you how this plays out in 3 phases. But first, if you're looking for stock picks, Seeking Alpha has outperformed the S&P by almost 8% over the last 12 months and by over 65% since 2022. There's a link for 10% off in the description. Now back to the 3 phases. We are in phase 1 right now. Dollar devaluation is propping up nominal earnings. The hiring freeze is masking unemployment. Consumer spending barely holding together with borrowed money. All 4 signals coexist in unstable equilibrium. Phase 2 begins around mid-2026. The new Fed chair takes office in May. They'll face an impossible choice: cut rates to save jobs and risk reigniting inflation, or keep rates high and watch unemployment spike. The current administration has been clamoring for lower rates, so it's a safe bet they'll try to cut rates aggressively. Markets may rally initially, but here's what changes everything. Rate cuts won't fix consumer spending. People are already leveraged beyond their limits, and lower rates can feed higher inflation, so the dollar buys even less and stretches consumers further. Rate cuts won't spur a hiring spree either. Corporations have figured out how to do more with less people. This is when confidence breaks. Phase 3 is when consumer spending collapses. Earnings miss, layoffs accelerate. Margin calls force selling because leverage is high and liquidity is low. A 20% drop becomes 30 or 40%, and that's when everyone realizes the 4 signals weren't contradicting each other. Gold warned about dollar devaluation. Stocks reflected nominally inflated earnings. The yield curve flagged a recession, and consumer spending was the last domino. Consumer spending is what breaks first. Everything else follows. So watch consumer spending signals. Retail sales declining, credit card and auto loan delinquencies, more layoffs and jobless claims rising above 250 or 260,000. When those break, you'll see it coming. None of this is personal financial advice. This is education so you can build your own plan. If this shifted how you see the current setup, hit subscribe. We publish fresh content multiple times per week, breaking down the economy and helping you grow and protect your wealth. And keep the momentum going. Watch how rich people make money with inflation. It's on the screen. In the description, you'll find links for 10% off Alpha Picks. You'll also see a link to my Wealth Builders Blueprint, a large collection of resources you can use to grow your wealth. I also included a link to Zach's Confidential, a more economical alternative to Alpha Picks. Check them out. Thanks for watching. See you on the next one.